I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week and a look forward at what might happen in the next week. And hopefully lots of ideas and opportunities for you throughout the show. Last 2 weeks, 2 weeks because I was off last week, the market was really in a tight range. The S&P 500, only a 28-point range in the last couple of weeks, and that's really small as it fights up against some resistance in here. We talked about that level 2 weeks ago. And for the last week, it's really been pretty flat. It just might be we're in the summer doldrums right now, and that does happen as we get into August and towards the Labor Day holiday. And we also may be in a point where investors are frozen based on fear about the election. You know, I have a lot of people that write to me and say to me, you know, why do you even talk about politics or about the election or any of that? And some of them write to me and they say, you know, I only watched the last 10 minutes of this show because they're mostly concerned about just what's going to happen in the short-term view of the market. Well, that's fine. Whatever works for you when you look at this show. For me, I talk about politics as it relates really to economics mostly, and that's because, well, I'm concerned about my grandkids. So I'm going to keep bringing up what I think the connection to politics and who we elect as president and how that affects the world as we move forward, and how that ties to markets too. In this case right now, maybe I'm frozen too because our choices really are about electing somebody who will keep us in status quo. If you like the direction we've been in right now, well, you know who to vote for then. I'm not going to bring up how I feel about that, but I think overall it's pretty negative. Or if you're willing to take a risk with a wild card unknown, maybe a crazy, that will change things possibly pretty significantly because, well, you think it's important that the free market gets revived. That's as far as I'll go with that. Then, well, you know who that candidate would be also. A lot of ifs, a lot of questions, and I'm going to keep bringing it up. And hopefully some of my input will be valuable to you in your decision making about politics and about the markets. So let me know. Maybe you're one of those people that would want me to bring up more things about politics and economics. Or maybe you're one of those people that only watches the last 10 minutes of the show. Of course, if you're one of them, you didn't hear what I just said. All right, so let's talk about other markets because some of them had some pretty big moves here. Oil, well, it's been a wild week. The analysts were talking just a couple of weeks ago about $35 oil, and it was sinking as traders, investors got really nervous. We felt we were in the final stages of potentially capitulation and that was going to end, and they even had us concerned about it. And by the way, do you hear that noise? That's because I live on the lakefront in Chicago and our air and water show is this weekend and they're practicing while I'm recording this show. I've asked them not to do it for the next hour, but they're not listening to me. So we're going to hear these jets come roaring by as they're buzzing my house. So back to oil. All this talk about it moving down to $35, well, forget about it. It moves from under 39 to over 49 in 6 straight days. That is a massive move, a move like we only see in times of panic about shortages, and I think everybody got caught short. I think everybody sold out based on all of that news. And of course, there was a lot of talk this week as they have scheduled an informal meeting September 26th to 28th that is the producing nations about a production freeze. This failed when they did this some months ago, as Russia wasn't exactly on board with it, and Iran, just plain and simply, they don't want to have any freeze while they're trying to get back up to their pre-sanction levels. So this whole idea of a production freeze may get blown up again, and that would bring us a pretty good pullback in the oil market. But basically, I think that we have seen the lows and we've seen the test. So we're going to be looking for some more volatility, maybe on both sides in there, and this coming up to this a meeting in September. That's a long time from now, like over a month, and we're likely to see some pretty good movement both directions. The dollar, we were expecting it to be weak. It turned south. Fed minutes were not supportive of a stronger dollar. That would mean they were supportive of a weaker dollar, right? Simply because they were totally confused. I'll talk a little bit about that in a moment. And giving us the same two-sided talk as if they really can control things anyway. And Thursday and Friday, we came out some other talk out of the Fed where a couple of the Fed heads were talking about rates going up pretty soon. That gave us a dollar bounce on Friday, but the dollar, I believe, is headed much lower. Gold, a choppy week. It's really in a corrective phase. We talked about a month ago or so, that it would be in a 1310 to 1370 range. It's been there. We believe that it eventually will break out of that range, and we would make the weight pretty heavily on the upside when it does do that. Gold stocks, let's talk about those in our worst of the week. They're in a corrective mode based on some pretty extreme moves that they had, and that might be bringing an opportunity also. So make sure you see our worst of the week. Bonds, they were very weak. We expected that this was a risky time. We thought there were about, when we did the show last, about 5 weeks that they could move on the downside. That would leave 3 weeks left, right? So today, on Friday, we're getting a pretty good decline, 30 years down over a point, as these Fed heads are out talking about rate increases. So a pretty good move to the downside in the bond market. So let's take a look at what the market actually did in this past week as we look at our 60-minute chart of the stock market. That's the ES, and we're looking at the gray areas, which are the overnight area, and we're looking at the white area, which is actually the trading during the day. Monday stocks went up. There was talk about Russia joining those talks, and that really gave oil a lift right in here. You could see that. And China also gained 2.5% as there was talk about stimulus over there. So that was the end of that whole $35 nonsense in oil, and we had the big gain. But that was the high of the week in the stock market right over there. Tuesday, stocks pulled back. It was really, not that big of a decline in there. Everything in here is really modest because we're in this tight range. The CPI came out weaker. It was a little softer than expected. And the dollar got hit on the weak inflationary news. And Buffett, when the news came out that it was exiting Walmart, or it exited the Walmart position, that also moved down. That stimulated the stock market to move to the downside. Wednesday, well, the FOMC minutes came out. Everybody was waiting for that. Oil had its 5th up day in a row. Retail sales came out weak, and the other stocks in that category of retail were weaker, and they moved to the downside. That helped the stock market get down early in here. But man, as oil continued up right like that for its 5th straight day, it drove the stock market higher, helped the energy category, and that's why we got that big lift. FOMC minutes, well, they said Fed, well, there was a potential hike for 2016, but they gave lots of caveats. They said that, jobs were stronger, but inflation was still weak. There was low capex. Now, low capex means that businesses are not planning on expanding. And I wonder why, because, well, the Fed keeps everything so cloudy. Nobody knows what the real economy would be if the central banks actually got out of the way, and they are concerned about the economy. Maybe we get one uptick in here because it's politically motivated, but I have some doubt about us having much of an increase. And if you saw my big picture on the bond market, I believe we're going to see a particularly strong move in bonds coming, well, not that far out there. Thursday, oil up for the 6th day. That continued to help stocks as you got a pretty big up movement here. Japan had a 1.5% drop, which didn't mean anything. Walmart earnings did come out and they were good, but I have some doubt about it being able to hold up. Cisco comes out, they're cutting 14,000 jobs. And that makes a total of $10 up in oil as of Thursday. And Friday oil is really quiet, as are all the markets. The only markets that are really moving in here are the bond market. As the bond market falls, I said on those Fed head talks, Dudley said on Thursday, labor improving. Williams said on Friday that waiting too long could be dangerous. You mean now is too long? What about 3 years ago? Crazy. And Deere, which I'll show you in a moment, has a monstrous move on the upside as they beat on earnings, and it's really not helping the markets, which are down just a little bit on the day. As I do this recording, S&P's down about $4, so not a big deal right in there. Our earnings and economic calendar for the week is right here, and earnings season is over. There's not much to report in there at all. You have Best Buy, which I will make some comments about in a couple of minutes, reporting here on Tuesday before the opening. I'll tell you those comments are not favorable. Hewlett-Packard after the close on Wednesday is another big one also. As far as economic events on here, there is not a whole lot to talk about until maybe 11 o'clock Eastern time on Friday, when Janet Yellen speaks about monetary policy, and of course that could be a pretty big good mover there of the market. So nothing really until Friday as far as that goes. That is the opening segment to the show, and I'll be right back with the best and the worst of the week. For the best of the week, while the market didn't make that many big moves, there were a few stocks that did. The biggest one was NetApp, Net Appliances, as that had a 21% gain. This one, good earnings, good revenues, analysts upgrading this stock. We actually thought that it was a decent stock based on the patterns, and boy, those jets are coming by. Living on the lake here, boy, this is the right place to watch this air show, but not so much for recording. So you might hear some more of this as we go. So NetApp, let's take a look at that chart right over here. We saw a base getting built in this stock. Didn't give it credit for the kind of move that it had here this week. Definitely a good looking move. Here's the base cycle right there that was built, and it was kind of moving this way. We actually thought it would correct a little more in here and then have a better move, but you can see that it had it very late in the cycle pattern right over there. I would say we missed this one. Didn't expect it to get all the way up to that major resistance level, that key support, that key resistance at the cycle peak right there, and the major 61.8, but there it gets right up there. So based on these patterns that we're looking at in here, that's this right in here, suggestive of some minor corrective period in here, and then moving up again. We'll call NetApp a good pattern right now. Urban Outfitters, this one really bucking the trend of the weak-looking stocks in the retail group, they had really gotten beaten up. This looks a lot like the pattern I just showed you, didn't it, in network appliance? Whereas it had the late rally right over here, takes off, then we're looking for a little bit of a decline or pullback, and then another try over here. I got to tell you, unless this company has completely remade itself and really appealing to the 20-somethings, I don't see how this stock is going to keep beating the retail category. I would be very suspicious of this one, and I have been all along, and as it went through some pretty tough times. So you can see late in that green zone, we're going to expect a yellow zone there that is just a modest correction, and then trying to get to the upside again. Earnings beat, up 18% on the week. The oils actually, most of them did okay. It was, we'll call it a mixed week for oil stocks here, as oil had this massive jump off of its lows. You would have expected that oils would have actually done better, but they didn't really. Marathon, the best mover in the group, up about 11%. APA, Apache, up about 7%. And Halliburton up about 4%. So there wasn't that many big movers in there. Let's take a look at this marathon pattern in here on the weekly chart. You could see in the green zone in here and trading on the upside. You know, there's this inverted head and shoulders look in here, and we really have to say that overall this is a good pattern. We expected oil to turn upward again. It was really taking a long time for us, and so we'll call this a good pattern. We wouldn't be surprised to see a test of the cycle peak right over here. That's right around the area of about $21.50. It's now trading at $16.65, so there's room in there. It might do something like this here and then more like that out over there. So it depends really, of course, on how oil does, and this oil pattern is much better than I think most analysts expected. Take a look at Apache, APA, and this one not so good. I mean, I'm not loving this pattern. Then the natural gas pattern is not all that good. You can see how we have that drawn in right now, and that this blip on the upside this week of 7% is more likely in a downtrend than it is in an uptrend. Maybe it's not as steep on the downside as we have that drawn. It could very well be something a lot more like this right in here, and then a better time of it towards the end of the year. So I'm not loving this pattern. To get repaired, it would have to move above 58.5 quite a ways, and I have some doubts about that at all. Halliburton, however, much better, and we're rethinking a negative pattern that we have here in Schlumberger, as this one looks very much like it's turned up again. Dotted lines in here as we explore what the best cyclical rhythm is, and that looks like the bottom right in here and turning up. You can see that right here. Coming up now to test these resistance areas. So that last peak right over there, coming up around, we'll call it 46.60. This 61.8% around 47.60. So right in there in that dollar range, close to where it's getting right now, is where we think there's some resistance. We would expect some pullback from there, but overall this is a much better pattern in there than we expected it to be able to continue. You can see the smaller pattern in there and the stair step upward. See that right in here, and then right in here, a modest correction, and then the next advance right here. Those are the cycle rhythms, and that's what we base our analysis on, really the core of it. Chesapeake, now that one gained 17%. It's really one of the most volatile in the group. Cheap little stock right now. They've sold off so much stuff that I just don't see how the stock does all that well. Is through trying to survive through their cash crunch, they sold off a ton of the company. So I don't know if there's enough left in there to support it, but big gain of 17% on the week. We have to look at Deere. Deere reported earnings. The earnings were good. Guidance strong. Revenues weak and a miss, but their conference call was really a lot more positive as they guided upward in it. The question is it an anomaly of a giant move in here, or is it going to fail? You can see when you look at this chart, man, do we have a lot of stuff on that chart. So I'll try to tune it in for you so that you can really see. What our expectation was that it was going to sell off one more time. Now this is this big week in here as it's up 11% on the week. All of it coming on Friday on that earnings report. You can see our dotted line in here as we expected it to continue down for another month before it then turned up again. So our rhythm is definitely off on this right now. I had this listed as one of my best stocks for 2016 based on the patterns as they were shaping up at the beginning of the year. That was a bullish pattern right in here, and believing that the ags were going to do better. You could see it actually has not been a bad actor for the year, but we didn't get it right for this last month. We're going to expect some kind of a pullback in here, and then after that a lot of big patterns are going to be turning up again September, October, and that says to us that if we get a pullback as we expect, it's probably going to be a buying opportunity. We're going to call this massively overdone today as it moves through all the resistance. Look at this daily bar all the way up here through everything, and I wouldn't be surprised to hear some downgrades come in this stock and get some kind of a pullback. We'll have some target in there for our subscribers sometime in the next week. Next one we're going to look at in here is Micron, MU. There was an article floating around about mobile DRAM chips and how much the demand was picking up. That's what we believed 2 years ago, as we thought this stock was going to really be a stock that did well. Well, it did well a couple years ago and then completely fell off as it looked like their product mix had really missed the boat. But now a big base formed. That's this right in here, and almost no decline right there, and then turning up again. That is really an exceptionally powerful pattern. We wouldn't be surprised to see a runaway on the upside in Micron pretty soon. So we're going to call this very, very bullish, and we would be buying dips in the stock given the opportunity. In the same category, AMAT, which is a semiconductor material maker, look as it blew above our projected pattern in here. And so what we were looking for was a pullback like right in here and then moving up like that. Well, it just continued on the upside in here. We'll be looking for a minor pullback into September and then up again. This semiconductor group looking much, much better. Up 8% as their earnings beat. Guidance was really strong in there. So that's a really, really good one. One more we're going to look at in here is DIX, DKS, and I am very suspicious of this move in here. So I got to tell you, this one I am short, and I was short for earnings, which wasn't good. This one, you could see this big nice base built in here and then this huge upside move. So a lot of this move that we've seen on the upside was based on, let me get a little closer look in here on the daily chart for you to see, was based on the fact that, well, the earnings are pretty good and their same-store sales beat, but this is all about the Olympic sales, and I think it's a flash in the pan. Now, I did some studies that you can go watch in our tools for tax videos, and I said that often record high volume, when you get it like that on a big upside gap, is an exhaustion. I think that was an exhaustion gap. I think it's way too far along in this rally. It came way too far based on the Olympics. And I think when they start looking past this Olympics and all of this pop that it got in sales, the stock is going to get a drop again. So while this is in the best for the week, up 7%, as they had this big gain, I got to tell you, I'm short it. I want to be shorter, and I think that this stock is going to have a sizable pullback. Sizable. Can't say that. So however I say it or not, I think it's going to fall from these levels, and I think that is an exhaustion gap. That's the best of the week. I'll be right back with the worst. For the worst of the week, If you remember the gold, silver stocks, they had moves that were enormous on the upside. In fact, way outsized for the amount of move we had in the precious metals. In fact, some of them actually quadrupled during this period. A good example of that is First Majestic, which is AG, a silver stock. That's going to go as our worst of the week, as the gold and silvers did have a pretty good pullback. AG down 14%, AU down 8%, Barrick Gold down about 5%, that's ABX. And we saw gold pretty much stuck in a range, and I'm going to show you in a few minutes that range as we look at the short-term view. You can take a look here at this move in this stock AG, and you can see this is our weekly patterns, and the cyclical rhythms in there are very obvious, aren't they? You can see this base, kind of a base being built right in there. The big rally and the pullback matches this declining period, and look at right in here, this is the corrective period. It looks like it has about another month to go, so we're looking for a similar thing coming up here in gold and silver. So as far as our intermediate patterns go, so you can see a big pullback in there. I sure doubt this one's going to get underneath that 13-week moving average right there, around 14.5. It could, certainly, but overall you could see this would be a pretty bullish pattern, comes down and corrects, and then turns up again. So you really want to think about being a buyer in late September as far as a stock like this goes, but down 14% on the week in what we'll call a correction. AU, which is Anglo Gold, in the same pattern that you can see in here. In this case, we have the cycle patterns envelope, so you could see how they create ranges. Here's your base right in here, your big rally, and your next big rally in the corrective phase right over here. Note the 13-week moving average coming up there, so we wouldn't be a bit surprised to see some bouncing coming in here, and then maybe a little bit more on the downside, and then taking off again. You could see September looks like the time period that the corrections are going to be over in these stocks right in here. Similar pattern in Barrick Gold, ABX down 5% on the week. So we'll just call them in corrective mode, and we have a feeling that come a little bit later on in the year, these stocks are going to have another surge to the upside. Cree gets hit. That's down about 14% on the week. Cree is the company that makes the LCD light bulbs, and that company is one that we really were suspicious about about 3 years ago, and had a big rush. And anytime you get where you have a single product that is really lifting the stock, you really always have to be suspicious. And Cree now taking it again on the downside. Their earnings came out, they missed, their outlook was really weak. And let's take a look here at this Cree chart, CREE, and take a look here at the weekly chart. So we had this stock in rising mode. You can see that right in here as it was in this positive phase. Now, based on this pattern in here, we would have thought it would have gotten up to this levels in here of the resistance, but overall it was not a great pattern. You can see these are our timing spikes, and they point to the significant low periods right in here where the cycle rhythms call for bottoms of declines. And now you can see in here that this goes all the way out to November, where you have that big decline right there. So this one, we're going to call this a really bad looking stock, and that's based on this bad gap. You can see right here also that this is right in here they sell wolf speed. You can see that right there. And then what they did right in here is had this big breakdown on earnings. So what's left up here is this giant island. I was waiting to draw this for you. So you could see this island right, oops, that's not what I want to do, right like this. Right there is your island, and so that giant island, the big downside gap, it might try to get some rallies up in here. Often you get this high volume on the breakdowns on these gaps, and it gets some kind of a rebound, but based on the weekly pattern I just showed you, let's go back there. This looks down into the end of November time, beginning of December, and we would say Cree is a very bad stock. Let's switch over now and talk about retail. Staples, SPLS. Take a look at this chart right in here, and let's look there, and you can see a downturn going on in here. Look at this 34-week moving average right here. Here it tests it and turns up. Here it tests it, turn down. Here it tests it and turns down again. And here it breaks it and gets into this big declining mode. Here's your cycle rhythms right in here where the bottoms were due. This rally in here fails, and now it's coming down to test the cycle bottom. That's bad. We would expect this to break down right in here and get back under the $8, maybe down to $7 level right in there. Staples, they reported a loss. They are closing stores. You know, it was in May that the judge blocked the merger between Staples and Office Depot. I'm highly critical of any time that the government steps in and does something like that. So here they are now having trouble closing stores, people getting fired, right? But what did the government do? They stepped in and thought, well, it wouldn't be competitive. You know, there wouldn't be enough stores that are selling paper clips and Post-its. So instead, they block efficiencies, improving efficiencies, where ultimately the stores can grow because they did better, because they thought that they want to decide how businesses should be run. So again, you know, my libertarian bones coming out. When I see stuff like this, I really want the government to stay out of the way. So Staples having trouble closing stores, and you can see why. All right, so now let's get to some more retail in here. We're going to look at Target. Interesting week for retail in that, Buffett gets out of Walmart. The stock gets hit, bounces back some. Target reports, and the stock falls 6% right in here. You can see this chart as it moves into a resistance zone. So where does the resistance zone come from? It comes right in here. You can see it has the big rally. It tries to make it to this high and can't. Then it has the big break. Note the cycle rhythms right in here where it has rallies and sell-off, rally and sell-off, rally and sell-off. So the low in here is due sometime around late September, beginning of October. This resistance zone right over here comes as you take the measurement on this decline. So this is 50% up, this is 61.8% up, and that is where it failed with that beautiful shooting star right there, and then turns over. So this one has a couple of months potential on the downside in that sizable break. Look at the daily chart in here. Again, my chart subscribers get all of this with all this information. Here's the evening star right there as it tries to get up through that 89-day moving average. It even had a fake out in momentum as this the slim ribbon started to get choppy right in there, and now has decisively turned to the downside. So we think Target has a lot of time left to the downside in there, and that's one that we would sell if it tried to pick its head up. Two more that we're going to look at here in this week. Lowe's reports earnings. They're not keeping up with Home Depot. That's doing better. Here's the pattern in here as it shapes up, and you can see the nice rhythms in here, and looking like this test of this moving average and that cycle bottom. That's very early in this cycle, so you can see this rallies up for a long period of time and then sells off and rallies to a new high. What did I do? I just traced this out. You can see that right there, and then it rolls over way early in this pattern with all of this time to fall in October. Do you want to be long this stock for the next month and a half? No way, because this is setting up a very negative pattern. And you can compare that, if you want, to a similar pattern right over here. You can see here as it rallies up about halfway and then turns down for the other half, rallies up about just 3 or 4 bars and then turns down, has all this time to decline. That is absolutely beautiful, and says low is negative. As a matter of fact, Home Depot chart is also looking like it's rolling over, so maybe Lowe's is telling us that maybe this period of low interest rates that's helping a lot of builders and helping a lot of people that are borrowing to do things in their homes, maybe that's coming to an end. Maybe people are tapped out. Take a look at Best Buy, down 4% on the week. This is one I really do not like. It failed right up over here at this last high, Note this pattern right in here and then rolling over right here. We would expect a couple of weeks more down in here, then getting a little bit of a pop and then rolling over again. So down about 4% on the week. But what we really want to look at right over here is the daily chart, and you can see why we think that this peaked. Well, here's your island top in here and upside momentum, which has been in place for all of this time, since right over here you get a gain from 30 bucks all the way up here to about 35 and a half. Now the momentum is lost, and that's the perfect spot for it to do it. And we think that Best Buy, BBY, is a stock that's in trouble. That's it. That is our worst for the week, and we'll be right back with the short-term view. All right, short-term view of the coming week, looking at 5 major markets in here, looking only at the daily charts, as we're taking only a short-term view. Try to project out about 4 to 7 days. Last time we did the show 2 weeks ago, I tried to stretch that out a little bit, and we take an accountability of how we did. We've been doing really well for over the last month, and this last couple of weeks, I would say, we did really well also. I would say over 80% on the short-term patterns. If we got anything really wrong, is that in the last week, that big up move in oil, we did not see that coming. The previous week it acted pretty much exactly as we expected, failing from our projected resistance area, pulling down. But then when it exploded on the upside in here, we did not project that to happen at all. As far as gold, the euro, the bond market, and the stock market, pretty much spot on, as these moves came in the shape of the patterns that we expected, and coming up to or down to areas that were close to as we expected also. So that's how we measure it, by how well the pattern shapes up and how the support and resistance zones that we put in there actually do act to support or resist the movements in the market. So let's take a look, as we begin always what we do, in light crude, and we'll take a look at the daily chart. And here is /CL, and here you can see that when we just talk about what we expected last week, we talked about that it was going to get up to between 42.25 and 43.75 and then fail and roll over. That's what we got. We talked about this pattern right in here, and that if that key level was broken, it would be bearish. But we didn't think that was going to happen at all. We thought that the odds were that it would turn up. So we got what we expected right in there, but that actually was not anticipating the power of this move on the upside afterwards, which had that really, really sizable gain, incredible, all the way up to this intermediate 78.6%. Based on the patterns we're looking at on here, we expect a minor stalling. I have this shape drawn on my notes on my for the show, and it says to me I expect some minor pullback, maybe hits the 23.6%. Well, that would be about 47.60 on a pullback, and then it's going to run out of time on these patterns and go up again. So if we get that as we expect, minor pullback and then an upward turn, we think we're going to see over $50 in the coming week. Maybe buy it around 47.5 and look for another big up move there. So that's a look at light crude. Next one we're going to look at is the gold market /GC. 2 weeks ago we thought it would be choppy with a downward bias for a couple of weeks, and that's basically what we got. We thought it would be in a somewhat of a corrective mode, and that if it went on the downside, 1314 would hold. It actually got down to 1334 and didn't break any further down than that. So we got this as we expected during that period, And now you can see in here that we have this pennant formation drawn in there as we expect that it's in a corrective mode. So this pennant formation, these cycles that nest out over here, those come out into mid-late September. So we're actually looking for a few weeks more of this kind of choppy action. We're going to say that a minor rally attempt in here fails. And that it stays in the range and in the pennant, maybe eventually coming down to that area of 1314 again, or low 1320s, and then turning up for what we think is going to be an upside breakout of that pennant coming in sometime in September. So that's a little longer term view. For the short term view for this week, we're just going to look for this right in here, a little upward attempt and then more chop sideways and on the downside. So that pennant is basically bullish, and it's in a corrective mode. We talked about the gold stocks correcting, having another some number of weeks ahead of them, and that matches this. There's your flagpole right in here. Here's your pennant right in here, and that's just a correction. Odds are about 2 to 1 that it eventually breaks out on the upside. So that's a look at gold. Let's take a look at /6E. So 2 weeks ago, we said there would be a small dip and then up. Man, oh man, talk about nailing it as it gets down into the support zone right over here. Small little dip right there, and then moving up sharply. We thought that it was going to be setting an intermediate term low on the intermediate charts, the weekly charts. That has occurred what's right in here, and now we're in this upward trend, as you can see it right like that, and the stair-step upward move. So if we have this right, continuing the pattern that it's been in before, we would expect a pullback. You could see these patterns right in here suggesting a minor pullback. Maybe you get to this minor support level right over here, somewhere around 1250. But then after that, we expect to move to about 1450, and that could be 2 weeks away, as that length right over here is a couple weeks. So we think if we get a pullback for a few days, that it's a buy and that it's going to be moving upward again. Next one we're looking at is /ZN, and that is the chart on the bond market. We said at that point that there was lots of risk in the market, and we said that there was at least 6 to 8 days of moving to the downside. That was this pattern right in here, and you can see we got that right in here, moving to the downside as it fell from our resistance area. We talked about that being a sell area. Now here's where we are again. Now this is a little lower minor resistance established in here. We think we have another few weeks on the intermediate term of risk. That's this pattern right in here. So what we're looking for is a potential little bounce in here. You can see how we have that drawn. If it gets there, we would expect it to roll over and move to the downside again. The Fed heads are going to be talking about higher interest rates now, and you can see that's getting in the way of any moves in the market. The ZBs, the 30-year, still looking like it does right now. This resistance, like this does, looking like if it gets a little bounce up to its resistance zone, and on the 10-year it's 32.13, 132.13 to about 18. That's what we think is the sell area in there. So we don't think it's got much potential for rally in here. Maybe just a few days of a bounce and then rolling over again. So that is a look at everything except the stock market. I'll tell you what, before we get to the stock market, I want you to just watch 30 seconds where I talk about what are askSlim products and services, and then we'll be back with the short-term view of the stock market. Thanks for watching that. And if you have any questions about our services, make sure you write to Slim at askSlim.com. All right, so let's get into our short-term view for the stock market. Every Wednesday I do Future Speak. That's the longest segment I do, almost an hour, where we look at 25 different futures contracts. Talked about at that time that the intermediate term seemed quite readable to me, and that the really short term was, I was getting help out of the intraday charts and momentum charts that were giving me some sense about the positive pattern that had been setting up, and that the reason I had thought that the stock market was going to continue moving to new highs. Now, the last couple of weeks I've talked about the fact that I thought that it was in a stalling period and maybe a little bit more of a correction. We'll let that jet go by, and then we would maybe see a move after that to additional new highs. I actually think that's really where we are right now, that we're entering into a little bit more of a corrective period than we've seen. You've seen the market over the last month basically stall as it, popped up to, like 20, S&P's up to like 2170s, and then popped up into the 2180s. Before we left, we said that 2180 to 2188 was a resistance level, that there was a Fibonacci extension zone in there, actually, a confluence of Fibonacci resistances that looked like it would hold the market. Basically, it has. It actually got up to 2193 and then backed off that day. So it hasn't proven anything based on those numbers. Now, when we look at this chart now, which is the daily chart on the S&P 500, it still is where it's, I've got to say, one of the harder reads of the stuff we're looking at in here. Now, note the diamond shape that's in there. The diamond shape is a consolidation pattern. It's not bullish or bearish. It just says it's consolidating, and then when it breaks out of that pattern, it gives you some sense of direction. Now, I'm looking at these smaller patterns in here that have been running about 9 days long. You can see that right in there. And when I put that up on my 2-hour chart and looking at momentum, it's got a lot of consistency to me. So what I see in here when I look at that is that sometime in the next several days we're likely to get into a corrective period. You can see that dotted line and that 9-day cycle pattern right in there. So what that says to me, and what I have drawn on my notes, is that maybe we have another little attempt on the upside in here, get to the top of this diamond area, but then I think we roll over right like that, and I think we're going to get into a very minor corrective period. We're going to look for the next 5 to 7 days, based on all of these counts, to get into a corrective period. If it tested the 23.6%, that would be right there at 2146. That's more volatility than we've seen. I'm expecting to get a little bit of an uptick in volatilities in here. And then after that, I think if that happened, we get into this pattern right over here, and there would be an opportunity to test that resistance at the 2212 area. That's ultimately where I think the high is going to be, but that's getting a little more into some big picture analysis. So for the very short term, what I'm really expecting is a little more choppy action, some rolling over, and then moving down into in this week and potentially the beginning of the following week. So that's a look at the S&P 500. So just hanging around that resistance area. We talked about 2180 to 2188, and it is 2182. So look for just maybe a little more chop, and then maybe getting sold for just a little bit of time. Take a look now as we look over at the VIX, implied volatilities. This is really a chart that had the opportunity to give us some pretty good upside move, and I would say it missed that opportunity. So where are we right now? Well, it looks to me like somewhere in these next few days we might get a pop in implied volatility, and that's exactly how these patterns look in here. But I don't think implied volatility pops are going to hold in here at all, at least not until we get past what I think is that final high that's way out there, maybe some number of weeks away. And that means that if we get some lift in IVs over this next, like I said, 5 to 7 days, that it's likely to roll over again and not be able to hold. That's based on the big chart analysis that I've done on implied volatility. This is really a substandard time for implied volatilities. It didn't have any of the bigger pops that we were looking for. Now I think it's running out of time for that. So we wouldn't be surprised to see small little pops in implied volatility up to about 14 and then pulling back into this, low to mid 11 range, and not a lot there, right? And it may be very much that way until we get to election time. All right, so that is it for our short-term view. I hope that this show has had lots of opportunity for you, and that you have a great, safe weekend, and that you really get into a mode of looking at all the things out there that might make this a better world, as I try to do every single week. So those of you that didn't hear my opening, that only watched the last 10 minutes, you'll know what you missed, because I made that little mention in there. That's it for the show for the week, and I'm always wishing you great trading.
Well, I'm going to sit